Hello, this is Martin from seekedge, the channel for learning about trading and investment. Welcome to the Option Trading for Beginners series, and today we are going to discuss about bullish spreads, basically the bull call and the bull put spreads. Let's go ahead. So what exactly is a spread? Spreads are nothing but options that is used, right? They create different long and short positions. No, they are put together, both long and shorts. They're put together to create option strategies, right? That's what basically a spread means. Here today we are going to talk about bullish spreads like bull call and bull put, right? So there are two types of option strategies. You can divide them as directional versus non-directional. Directional is what we are going to talk about. When we say that we have bullish view, it means we are directional, right? We know where the price movement of the market goes. When we say we are non-directional, we're not sure where the price may end up for this expiry. That's non-directional, right? Bullish view, what exactly do you mean by bullish view? The asset, that's a stock or the price, if that is expected to move upside, move towards the price is going to increase, that means we have a bullish view, right? And what does risk defined means? Risk defined is a position that we take in the options, using the options, where we know where exactly the return of investment is. What are the risks that is there involved? What is the maximum profit that we can get? What is the maximum loss that we can make? What are the capital requirements for it? When does it become break even? What is the probability that I will win? Right? All these details are defined, and when we take such a position, we say that it's a risk defined position. So we can take option risk defined positions. So what we are going to learn today, the bull call and the bull put, are risk defined strategies of options, which are bullish view, which are directional, which are spreads. So we know what spread, directional means, spreads means, bullish view means, risk defined means, right? Let's move it. So what are the different bullish option strategies that are popular, that are known? One is the bull call option spreads, which you are going to learn today. The bull put option spread, which you are again going to learn today. There are other bullish setups that we can do with the help of a simple long calls, or using a call butterfly, which is nothing but, right, we are shorting two calls and then taking hedge positions at the call and the put sides. We are not going to talk about the long calls or the call butterfly today. Long calls are dangerous, right? Bull calls and bull put strategies or spreads are an alternative to long calls, basically, right? So long calls are not recommended. It's highly risky. We talked about the option buying a risk, right? So when we are buying a long option, hoping that the market would directionally move up, if it doesn't work, we lose money, right? If it is sideways, we lose money, right? So even if our direction is correct, we can lose money. So it's not recommended to have long calls. We're not discussing about that. For beginners, it's not recommended at all. Call butterflies are used if our view is not directional, right? We are directional, but but we want to hedge it, and then we want to. So it's a different strategy that has got multiple legs, more than two legs, basically, right? While what we are going to discuss is a very simple bull call and bull put spreads, which has got only two legs, right? Let's move ahead and see what are those. Bull call spread, how do you construct that, right? Basically we construct it for buying a one in the money call option. In the money is the moneyness of the call option, which I assume that everyone knows. You all know. If not, we can discuss on another video on the same. So we buy a in the money call option and we sell an out of the money call option. These two together we call it a spread, which is a bull call spread, right? We We buy and we sell also. We just don't do just a buy. We sell and buy, both we use options to minimize the loss, right? No, and also to increase the probability of the win, right? So both, no, so whatever defects are there for naked buying of options can be eliminated, right? If we are taking bull stocks, so we construct it by doing by buying and selling two call options, using call options only. That is what bull call. No, so this is how the spreads. We'll come back to this in the demo session later, where we'll see how exactly we can create one. So this is how exactly a bull call spread will be. So we are buying 15,800 calls. Yes, selling 16,000 calls. Or we use that, the market will move up, right? The market moves. What happens? Whatever call options we have shorted will, right? Call options. What happened to the call options that we have bought? Call options that we have bought will increase, right? When the market moves up, call options that we bought will increase, but the call options that we have sold will decrease, right? So as an option seller, when we are selling call, and if it is option value is decreasing, means we gain. So in effect we gain, right? So if the market is coming down, right, still we gain. Market is going up, still we gain from the long. Market is coming down, still we gain from the short, right? You can see the different things, the probability of the profit, the maximum profit. These are all risk defined. The maximum loss, the maximum risk reward, the break evens, the total P&L, and the margins and the net credit that we get. So bull call spread is a debit strategy. That's why you're seeing net credit is 0, right? So probability of the profit is the probability that the price from the place where it is taken, right? What probability is there for it to move? I'm sorry. Yeah, let's come back. So what probability is there for the price to move, right, across the standard deviations, right? So which is seen as around 50% of probability is there. Maximum profit that we can make if we deploy this, maximum loss that we can make if we deploy this, right? There are methods, calculations which you get to that. Risk reward is like how much of money that 1:0.9 means if I put in 1 rupee of risk, I will make almost near to that 0.9. That is the risk reward ratio. Break even is what point in time, what particular strike would I be neither loss nor profit level, right? Margin is the capital that is required. See the low margin, it's around 15,800 is the margin that's all required, right? Let's move ahead and see the bull call maximum profit and maximum loss and the break even point. Maximum profit is calculated by, no, it's not very complicated, right? The difference in the strike minus the net premium. Let's go back here. The net premium is the difference of 285 and 180. That is net premium, right? If you subtract that amount from the strike difference is what? 200. The strike 15,800, 16,000. Difference of that is 200, right? So 200 minus whatever is there, right, multiplied by number of lots is what would define the maximum profit, which is 4,700. Maximum loss, how do you calculate? Is the net premium paid. Net premium paid is what? 285 minus 180, right? That would be the maximum loss, that will, right? And the break even point is the point where it is neither loss, this particular point, right? How do you find that? We find that by finding the strike price of the long call, right? Where is the long call? 15,800 is a long call, right? 15,800 strike plus the net premium. Net premium is 285 minus 180. But that amount, if we add with the 200, we will get to know that amount is calculated as maximum loss, which is 5,250, right? Let's move ahead. So when exactly do we use this bull call spread, right? If you are moderately bullish in a short term, we use a bull call spread, right? So where we are expecting that the price is going to move upside, right? So if you look at the charts, technically we'll say the price is at a support level, and it may bounce upwards, may move upside from that support level, That's the ideal place. The support levels, if the charts indicates at a support level, that's the ideal place will be. If we have a bullish view, we go ahead. Okay. When the volatility levels are low, that is where the implied volatility is low, means that is ideal for a bull call. Right? But overall, the daily volatility also has to be there. If there is no volatility, if it is not at all volatile, then we will not have premiums, and it will not be attractive to do the option selling or buying. Neither of that, right? So there has to be minimum volatility. It has to be liquid stock if you're doing it in stocks, right? And implied volatility has to be less than the historical volatility. We can find all this information in popular option tools like Upstra or Sensible or tools like that, right? See the IV, and even in the NSE also, HIV and implied volatility information. NSE website also you can see that the implied volatility of the stock has to be less. So that is the ideal situation when bull call spread is favorable. Now there are many times that bull call spread may not work. That means we expect the market to move up, right? So different scenarios. It may move up, it may not move at all, it may move sideways instead, or it may move down. So what do we do if it is moving up? Moving up means it's in our favor. It's a bull call, it's a bullish strategy, right? We just have a target that is set for as per the trade plan and then book the profit, right? And the price moving very slowly, what do we do? Right? We can move that to the next month. Right? So that way we are converting the bull call into a bull call that is calendar spread. Bull call calendar spread. Calendar spread is nothing but the if you are taking the strikes of the next expiry, weekly or monthly, then it becomes a calendar spread. So if the price is moving very slowly, we can convert that. It's not a lot moving. So if you are taking a bull call spread for a longer period of time, right, on a monthly or something, and the price is not moving at all, then convert that into a bull call calendar spread. Right? And if the price is moving down against what you are, that is when the real adjustment is required. Real adjustment is the last part, right? Real adjustment is the last part. There you can convert that into a bear call, right? So basically the short calls that are making the loss, right? You just close that and then take new close, but that closing the strike will be lesser than the long call. What is the remaining long call? Lesser. So then it becomes a bear call. So convert a bull call into a bear call strategy if it is reversing. So we expected the market to move on. Our view was that. Now it is, we want to adjust and we have enough time. Then we wherever the loss making short call is there in our positions, we close it at a loss and then take a new short call which is at a strike that is below. So when it is strike below, which is known as bear call, which we will be learning in the next video, not in this. We'll be talking about bearish strategies, right? That means our bullish strategy has failed. We are adjusting it to make it into a bearish strategy. That's all, right? Now let's go into the second one, which is a bull put spread. Bull put spread is also a bullish strategy. The only difference is that instead of calls, we are building this with the puts, right? So we don't simply buy puts. Simply buying puts is instead we use buying and selling both together to minimize the loss and increase the win probability. So in the bull put, what do we do? It's a bullish view, but we use puts. We sell the ITM in the money puts and buy the out of the money puts, right? That is how we construct, right? So here is an example for a bull put spread, right? This is the payoff chart. Okay, so what do you see here? The higher strike is actually sold. So and the lower strike, right? What do you see here? See the ITM strike is, for a put, the ITM strike is 16,000, right? For a put, the OTM strike is 15,800. Currently the market is 15,860 something, right? So the OTM is 15,800 put, right? And the ITM is 6. So ITM we sold it, right? So net premium is actually a credit. So bull put is a credit strategy, right? Not while bull call is a debit strategy, right? Here also you can see all the parameters of probability. There is more or less the same probability of making the profit. The probability of winning, not losing, is, right, how much of price fluctuations in the premiums can happen from the median. The maximum profit, we can see that it is, right, we'll see how it is calculated. Then the maximum, so risk defined parameters are this, right? The break evens, the risk reward ratio, how much of risk we are taking proportionally, how much of reward we can get, right? How much of net credit we are getting, what is estimated margin. Margin is slightly more here, right? You can see that 24, other one at only 15, depends on the premium. So because it's a credit strategy, right? Credit strategies normally have much higher, right? So we'll see how it is calculated. For the bull put spread, the maximum profit is net premium paid. For the bull call, the maximum profit was maximum loss was what we get when you say the net. Here the net premium that we get is 300 minus 208, whatever, 92 some levels. That is what is going to be the loss. Then multiplied by the lots, that's going to be the loss. That amount is coming to how much? 5375 is the maximum loss that you get. Well, it's the maximum profit. Yeah, maximum profit all we are talking about. So maximum profit is the net premium, right? And maximum loss, we can see that the strike of the strike differences, right? 16,000 minus 15,800. So strike difference is 200. So the 200, right? If you subtract the credit that we receive, what is the credit? It's 92 something that we subtract, multiplied by the lot size, we'll get the maximum loss as 5,003. So here the risk reward is 1:0.86, not 1:1, slightly smaller, right? Break even point is the point where, how do you calculate that? We calculate it by the strike difference minus net premium, right? No, the strike price was short put. The break even is calculated by the strike price is the short put. What is the short put here? What is shorted here? 16,000, right? So if you subtract the net credit that we received, 16,000 minus whatever, 300 minus 200, 100 points, that is what 15908 is, which is the break even. 15908 is the break even is calculated based on the short puts, right? If you just look at the charts and then go 2-3 times, it will be very easy. But if you have if you use tools like this, like OPTION, this calculation of the maximum profit, probability, loss, break even, all this would be automatically done for you. But knowing this, there's no harm in knowing this. It will strengthen your concepts also, right? This is the formula based on which this payoff charts and the risk defined parameters of probability of profit, max loss, all this is calculated. So that's what bull put spread is all about, right? This is a credit strategy, as I mentioned earlier, right? So when do you use this bull put? Again, when you have moderate bullish view in a short term, we use this. The price is expected to move upside. That's what bullish means, right? Price is at the support level is ideal, wherever there's a chance that it can move up further. It's not breaking down, it's going to move up. If that is what our view is, we take this. Strategies are based on the views that is formed. So the implied volatility, higher level is where it is better, because it's a credit strategy. There is a theta effect. So the credit is, if the IV is high, there's a chance that YG will go up high further, and then mean revert slowly it will crash, come down. So that is when theta decay will happen. So higher IV is suitable for credit strategies, right? Now volatility, the stock of the index has to be volatile and has to be highly liquid. So do not pick anything where it is not moving at all and not liquid at all for bullish strategies, right? So IV has to be greater than the historical implied volatility, right? So earlier what we had seen is IV has to be lesser for the bull call. So here we are seeing that the IV has to be greater than the historical. That's ideal for a credit strategy. Adjustments, moving up, fine, very good, no problem, book the profit and as per the trade plan target that you have set. Now it is moving up very slowly, means you can convert that into bull puts calendar spread. The only thing is the strikes, you close the short put and then take another short put which is at a different month. So you change that strike for the next expiry strike, right? So if it is moving up, means there is more chance that you may end up in profit. But if the price is moving down against what you're doing, one option is to convert this into an iron condor. Why do you make iron condor? You have to buy a OTM call at a higher strike and OTM put. We'll be studying in the next videos what iron condor. It's a non-directional strategy where you can minimize your risk, and also the break even also make it extended further if you convert that. So that, and if the price is moving down, then you can always convert it into a bear put strategy, which we'll be studying in the upcoming videos. So these are the possible ways of adjusting Now, in case a bull put goes wrong, so when we say convert a bull put into a bear put strategy, it means that our view has changed. Our view has failed. It is going down. We are supposed to, we are hoping that it will go up, but the view is broken. Now we change. We are go reverse. A bear put is a bearish strategy. We gain to benefit from market going down. So only if you're very sure that the price is going to, never going to come up, is where we would go for a reversal. Until then, we will not adjust that, right? So adjustments are done just very close to the break even or when immediate to the break even. So it is a very quick action that has to be taken if you are doing that adjustment. There are two ways: either you take the loss and then be happy about that, or you adjust it and then continue with the trade. So possible ways of adjusting the bull call spread, which is supposed to be bullish and it is reversed, are either to convert into a bear put bearish strategy, or convert into a non-directional lion call strategy, or move it into a calendar strike price, right, where we benefit, right? Because calendars, the theta decay will be slower if you're taking a calendar. So these are the adjustment options that is possible for the bull put spread. Now these are some general rules when you're trading this, right? So first there has to be a view that, before we take, we will not take positions based on somebody else calls. Somebody says, go for a bull call. We don't do like that. We first look at the technical charts, study and know the technicals and the charts of the particular stock, index, whatever your asset that you're trying to trade. You should have a view. You should frame a view based on, it can be technical charts and open interest analysis or whatever, data analysis, quant, whatever you use, you get a view. Your view has to be either bullish, bearish or not, right, or sideways. So if it is bullish and bearish, that means you have a direction. Here we're talking about bullish, so view is very important, right? So you that view, if it is with conviction, we will not get out, or we will not panic, we will not put stop loss, we will not do all those things, right? The view is very important. Now the days left to the expiry is also, if you want to get good premiums, then you should buy it at an appropriate time. So if you are a weekly expiry, if you are trying to plan to take a position of a bull call or bull put, you should do it in the beginning of the month, right? The beginning of the week or beginning of the month, wherever the expiry is, right? And not in the last day of the expiry or one day before that. It won't work. So the days to expiry is very important, right? So you should give enough time, for us to adjust it, or you can't adjust it on expiry day, right? It's very difficult to get it back into profitable at that point in time, because premiums have eroded and gamma effects and many other things. So adjust only when it is needed, right? Ideally there is no need. If you have a view with conviction and then we have created a strategy that is with probability and the risk defined and known to us, with the probability capital, everything is known, there is no need of adjustment basically. But still, if you want to make adjustments when you have sufficient days to expiry, and then you want to reduce your loss if something has gone wrong, that is when you adjust, right? You don't adjust just to make profit, you adjust to cut short your loss basically, right? Now cutting the losses early, when we know that the break even is gone, right, the breached, then there's no point in, you don't want to adjust also, there's no scope for adjustment. Then you have to cut the loss and accept the loss instead of hoping that it may come reverse back and all that. That never happens in market. Accept the loss, take a fresh trade, right, based on a fresh view, right? Now mastering every strategy, these are two strategies that you have learned here. So you have to master that by doing at least 100 trades before, without any breaking the rules. Only then you must, you think of switching, because every strategy will work if you are taking it based on a view and based on set of rules, and do it consistently over a period of time. It will start working, right? Otherwise there's no point in switching again. Over trading, only the benefit is for the brokers and not for us, right? So next point is, book the profit whenever don't wait for the last day or the maximum profit potential to reach before you can take that. It now works from on option strategies. So you have to book the profit at 30 to 50% and then take a fresh trade for the next expiry. So putting a stop loss on, instead of, so these are risk defined strategies. We know what is the maximum loss. There is no, we have accepted that before taking the position. So there is no point in putting stop loss on each leg. So if you're putting that, stop loss, there's no point in taking the option strategies, right? The hedge strategies themselves are stop loss. We know what is the maximum loss. You should be ready to accept that before you take the trade. Now also one of that breaks even, then you close that leg and continue the next leg and all will not work, because markets are random. Like, it gives you surprises many times, right? You think you will close and go directional with only one profit making leg, and then suddenly it reverses. Means that same thing that was giving you profit would give you huge loss, and there is no leg left to support you, right? That's all risky way of approaching with this strategy. Now, don't keep it. I already mentioned that don't keep it till the expiry day to get the maximum profit, right? Book the profits, because gamma risk is can be in either ways. It can go down also, or also, so it is risky there. Don't wait for the. So most of the time, as you near to the expiry, the gamma effect will be more. Now, if you are given a choice between bull and bull put and bull call, both are bullish. Which one will you take? Look at what is the least loss making one. Look at the charts, payoff charts, and then apply the risk defined parameters, and you will come to know. You can calculate and find maximum loss is where maximum loss is less in the bull put, in the credit strategy that we chose just now, right? As compared to the other one, just in this example that we discussed earlier. So go for that if there is a confusion. But IV volatility belts is what the ideal approach of taking the choosing between the two options that we already seen that. Now the credit strategy benefit from the theta decay. That is why it is having less risk, but higher capital and all that, right? So the sideways also. So this is a bullish strategy, but if you're taking a credit strategy, you get the theta benefit also. Like time decay. So say it was bullish for 2 days and then sideways for 2 days and then finally bullish. So in between time also you gain, right? Now finally, most important thing is when you do not try to put all your money, or your take 100 lots capital, 100 lots on this strategy and then trade it. So that doesn't work in any of the strategies, including option strategies. Position size has to be always per trade. It has it should never be greater than 1% of your total capital, right? Whatever lakhs or crores that you have, every trade that you take should not be more than 1%, right? The risk, right? So if the risk is more than that, then you are in trouble. So that's a general rule for any trading, right? So now we will see a demo on how to create a spread from Abstra tool, and then how to put that in order execution setup, right? Uh, yes, yeah, let's look at that. So, so this is Abstra. I'm logging in. So I go to the strategy, and I choose nifty. The same. We'll see the same strategy that we have taken. So 16,000 as right, bull call. We sell it, and 15,800 we buy it, and here you have bull call spread, right? Similarly, you have 16,000 put, and you sell it, and you have 15,000 put, I buy it. Here is a bull put strategy that we discussed about, right? Now let's go to kite. Nifty July 16,000 call is to be sold. Nifty July 15,800 call is to be bought. What do you have to do that? I'm trying into, so buy has to happen first, right? It's a bull call. Now nifty July 16,000 put, you are selling it, and nifty July 15,800 put, you are buying it. Put the buy first, and here is your strategy, which is a bull put spread, right? And so you can see that the margin is so less, right? The moment you don't have this, the margin comes 88, right? So that's what bull put, and this is how we execute, right? Strategies, fine. So that's all I have. And please subscribe, leave your feedback, share it to your friends and family, right? So that they can also learn, and it also becomes great encouragement for us to come out with better content every time. Right? Thank you very much for watching this, and happy trading and happy learning. Bye.